A regulatory agency announced Saturday that the Democratic Republic of Congo has extended its ban on cobalt exports for 3 more months, a measure aimed at curbing oversupply of the key material for electric vehicle batteries. The world's largest supply of cobalt, the country had imposed a 4-month export ban in February after price hit a 9-year low of just $10 per pound.
Democratic Republic of Congo. As the country moves to tighten control over cobalt exports, President Felix Tshisekedi has issued a warning.
The Democratic Republic of Congo has extended a ban on the trading of minerals from 38 artisanal mining sites in the conflict-hit North and South Kivu provinces.
The decision did not arrive with speeches or ceremonies. It surfaced through customs notices, revised export permits, and a sudden tightening of inspections at border crossings. When the Democratic Republic of Congo moved to halt the unrestricted export of cobalt, the message was unmistakable even without dramatic language. Africa was no longer willing to play the role assigned to it for decades. The strike back was quiet, administrative, and devastating. Cobalt had long been treated as an invisible ingredient of Europe's electric vehicle ambitions. It powered batteries, stabilized supply chains, and underwrote green transition promises. Yet for years, its origin remained distant in policy debates, reduced to a line item in procurement spreadsheets. The Democratic Republic of Congo changed that equation overnight by asserting control over how, where, and under what conditions cobalt would leave its soil. The immediate shock rippled across Europe's industrial corridors. Battery manufacturers paused expansion plans. Automotive factories recalculated production schedules. Investors questioned timelines that had been marketed as inevitable. The dream of seamless electrification suddenly collided with the reality of dependency. Africa's reasoning was neither impulsive nor symbolic. The Democratic Republic of Congo had watched raw cobalt leave its borders while value was created elsewhere. Processing, refining, and battery manufacturing had flourished overseas, while mining regions absorbed environmental strain and social pressure. The ban reframed cobalt not as a commodity, but as a strategic asset tied to national development. Europe responded first with disbelief, then with urgency. Policy circles scrambled to assess alternatives. Recycling initiatives were accelerated. Substitution research gained funding. Diplomatic channels reopened with unfamiliar humility. Yet none of these measures could replace the scale and quality of cobalt controlled by the Democratic Republic of Congo in the short term. Africa observed carefully. The ban was not absolute isolation. It was conditional engagement. Export pathways remained open for partners willing to invest locally, share technology, and commit to downstream processing within Africa. The signal was clear. Access would now come with obligations. This approach resonated beyond one country. Neighboring states, also rich in critical minerals, saw an opportunity to align strategies. Informal consultations expanded into regional coordination. The idea of competing against one another through underpricing gave way to the logic of collective leverage. Africa began to act less like a collection of suppliers and more like a block of stakeholders. Europe's electric vehicle strategy revealed its fragility. Decades of industrial planning had assumed uninterrupted access to external resources. Environmental standards focused on tailpipe emissions, not upstream extraction. The cobalt ban exposed a contradiction at the heart of the green transition. Sustainability without sovereignty was unstable. Manufacturers faced hard choices: either invest in African processing facilities, accept longer lead times, and share margins, or risk production slowdowns that could erode market confidence. Some companies adapted quickly, dispatching feasibility teams and revising contracts. Others hesitated, constrained by shareholder expectations and regulatory uncertainty at home. The Democratic Republic of Congo held its position. Revenue projections shifted as raw exports declined, but domestic investment surged. Processing plants, once discussed only in policy papers, moved toward construction. Training programs expanded, energy infrastructure received renewed attention. The ban began to reshape internal economic planning around value retention rather than volume extraction. China watched the developments with pragmatic interest. Already embedded in parts of Africa's mineral ecosystem, China adjusted its engagement to align with the new framework. Joint ventures emphasized local processing. Long-term supply agreements incorporated technology transfer. Stability, not speed, became the priority. Europe's frustration was not only economic but psychological. The assumption that Africa would always supply raw materials without conditions had gone unchallenged for generations. The cobalt ban shattered that assumption. It demonstrated that control over critical minerals could be exercised without confrontation, using policy instruments rather than rhetoric. Public discourse in Europe shifted. Media narratives questioned over-reliance on foreign inputs. Policymakers debated strategic autonomy, environmental. Groups confronted the externalization of mining impacts. The electric vehicle dream did not collapse, but it lost its aura of inevitability. Africa's message extended beyond cobalt by asserting control over one mineral central to the global energy transition. The Democratic Republic of Congo set a precedent. Lithium, copper, manganese, and other resources suddenly appeared in a new light. The era of unchecked extraction was ending, replaced by negotiated access. Markets adjusted unevenly, battery prices fluctuated, stock valuations corrected, long-term forecasts were revised. Yet amid the volatility, a new equilibrium began to form, one where Africa's role was active rather than passive. The strike back was not about punishment, it was about repositioning. Africa sought to move up the value chain to convert geological advantage into industrial capability. The cobalt ban was the opening move in that strategy, not its conclusion. Europe faced a choice: adapt to a world where Africa set terms, or cling to outdated models and absorb the costs. The Democratic Republic of Congo had already chosen its path, and in doing so, it reshaped the global conversation around energy, equity, and power. The electric vehicle dream was not shattered beyond repair. But it was cracked, and through that crack, a new reality emerged, one where Africa was no longer invisible, and where the future of green technology depended as much on political balance as on engineering ambition. The consequences of the cobalt ban deepened as weeks turned into months, revealing layers of impact that initial market reactions had overlooked. What began as a supply disruption evolved into a structural challenge to how Europe imagined its future. Electric vehicles were never just machines. They were symbols of progress, climate leadership, and industrial renewal. When the flow of cobalt slowed, that symbolism was tested. Across Europe, governments convened emergency task forces. Energy transition roadmaps were re-examined line by line. Targets that once seemed conservative now appeared dangerously optimistic. The Democratic Republic of Congo had not merely restricted a mineral. It had forced a reckoning with assumptions embedded in decades of policy. Africa's position grew firmer as clarity replaced uncertainty. Officials emphasized that the decision was rooted in sovereignty, not hostility. For too long, mineral wealth had translated into foreign profits and domestic vulnerability. Roads near mines deteriorated while ports overseas expanded. Schools lacked funding while overseas. Battery plants multiplied. The ban reframed the narrative. Resources would now serve national and continental priorities first. This shift resonated with African publics. Communities that had endured extraction without visible benefit began to see the outlines of change. Processing facilities promised skilled jobs rather than temporary labor. Local universities partnered with new technical institutes. Discussions about industrial policy moved from abstract forums into everyday conversation. The idea that Africa could shape global supply chains no longer felt theoretical. Europe's response fractured along national lines. Some countries pushed for aggressive diplomacy, urging compromise and warning of mutual losses. Others advocated acceleration of domestic mining, even as environmental opposition intensified. Recycling was presented as a partial solution, but volumes remained insufficient. Substitution technologies showed promise, yet scaling them would take years. The timeline mismatch became unavoidable. Africa was acting in the present. Europe was planning for a future that required uninterrupted continuity. The gap between those timelines exposed vulnerability. Automotive manufacturers, once confident in just-in-time logistics, began stockpiling materials, driving prices higher and volatility deeper. Global investors recalculated risk. Projects in Africa that included local processing clauses attracted long-term capital. Pure extraction ventures lost appeal. Financial institutions adjusted lending criteria, recognizing that political alignment now mattered as much as geological surveys. Africa's leverage extended beyond minerals into capital flows. The Democratic Republic of Congo became a reference point. Other resource-rich nations studied the cobalt ban closely, not to replicate it blindly, but to understand its mechanics. The lesson was not about bans alone, but about coordination, clarity, and credibility. By communicating conditions transparently and enforcing them consistently, the country avoided chaos while maintaining leverage. Europe's electric vehicle ecosystem began to adapt. Some manufacturers entered joint ventures to build processing capacity within Africa. Others restructured supply chains to include African partners as stakeholders, rather than suppliers. These adjustments were costly and slow, but they marked a departure from extraction-only relationships. Public perception shifted on both continents. In Africa, the ban was increasingly viewed as a statement of maturity. It signaled readiness to negotiate from strength. In Europe, it triggered uncomfortable debates about dependency and moral responsibility. The green transition, it became clear, could not be outsourced without consequence. Environmental narratives grew more complex. Activists questioned whether Europe's climate goals justified environmental degradation elsewhere. The cobalt ban forced alignment between sustainability rhetoric and practice. If electric vehicles were to represent ethical progress, their supply chains would need transparency and fairness. China's role evolved quietly. Rather than contesting Africa's demands, China adapted. Long-term agreements incorporated training, infrastructure, and shared ownership. This pragmatic flexibility contrasted sharply with Europe's initial resistance and gave Africa additional bargaining power. Competition between external partners began. To benefit African negotiating positions, the European Union accelerated strategic autonomy initiatives. Critical minerals were reclassified as security assets, funding increased for alternative technologies. Yet even with these measures, the realization persisted that autonomy could not be achieved overnight. Africa's cobalt remained irreplaceable in the medium term. Africa's confidence expanded. What started with cobalt encouraged broader conversations about trade terms, industrial policy, and regional cooperation. The idea of exporting finished or semi-finished products gained traction. Minerals were no longer endpoints. They were beginnings. The electric vehicle industry felt the pressure most acutely. Production targets slipped. Marketing language softened. Companies spoke less about inevitability and more about resilience. The dream survived, but it adapted, shaped now by geopolitics as much as engineering. Europe faced its reflection. The cobalt ban exposed a contradiction, the desire for ethical leadership without relinquishing structural advantage. Africa's move challenged that contradiction directly, without confrontation, through policy. The global balance began to tilt. Africa was no longer the silent foundation of other regions' ambitions. It was asserting authorship over its role in the future. The Democratic Republic of Congo's decision marked a turning point, not because it ended Europe's electric vehicle plans, but because it redefined who gets to shape them. In this new landscape, cooperation replaced assumption, negotiation replaced entitlement, and minerals became instruments of strategy rather than symbols of extraction. Europe's electric vehicle dreams were not destroyed, but they were transformed, now tethered to African agency, African priorities, and African terms. The shockwaves continued to travel outward, touching industries, governments, and ideologies. And as they did, one truth settled into the global consciousness: the era of Africa supplying. The world without conditions was over, and the future would be negotiated, not inherited.